Welcome again to this section. We'll be looking at a particular concept, some call it break-even analysis. We will look at it from a more broader perspective, which is the cost volume profit analysis. Like the name sounds, cost. Cost of what? Production, of course. Volume. Volume what? The volume of units we produce. And profit. You always want to sell and make profit, isn't it? Yeah, it is. So that's what we'll be looking at in a very typical way. The reality here is that when you start any business venture, any production activity, you may make a loss, isn't it? Because maybe it's a new business you are starting. You've not really been experiencing it. But over time, when you make a loss, you see that a time will come when you don't make any profit. You don't make any loss. That is a break even. Zero profit, zero loss. And afterwards, you can migrate to the profit zone. That's what we want to look at. But there are a number of things we'll have to look at. What kind of pricing strategy do you use? What kind of costs are available for production? Are all costs the same? Cost behaviors, do they change? Let's look at this. I share my screen once again, and then we hit it hard as we move on. All right, so we'll be looking at cost profit volume analysis, costing. So more on a broader term, the costing, the CVP analysis, and the pricing decisions corporations undertake in their work. All right, let's move on and see. At the end of the day, you want to appreciate the difference between fixed and variable costs. Also understand the importance of cost volume profit analysis for any organization. And I want to familiarize yourself with the concept of contribution margin and the role it makes. What is contribution? Contribution margin, this is the typical management accounting term. It's more like a profit. That's all. It's like profit, gross profit, to be precise. Now you will hear responsibility-based cost measurement system or responsibility centers, cost center, investment center, profit center. If you get one example, you get the rest. Okay. Why do managers want to know the full cost of a product? They want to use it to make very good pricing decisions. How much should we sell this? Because this is how much we get in producing it. They also want to use that one to make a decision. Should we continue making this product or we should buy it from outside? It also helps them to plan for the future, budgeting. And it also helps them to control cost. So they will benchmark the production cost this year against that of last year and use it to plan for next year. And then use it for performance evaluation. Why is cost exceeding what we budgeted for? Why is cost less than what we budgeted for? Did this exceed the budgeted because suppliers increased their prices? Did it drop because we got a lower supply, a lower option of supplies from another supplier? So these are some of the reasons why managers want to know the full cost of an item. Now, responsibility cost measurement system, they use responsibility centers as a focal point. What's a responsibility center? So a responsibility center is any sub-unit of the company. It has a manager who is responsible for performance, and it has a budget. Typically, what we are saying is it's a department with a departmental manager. They've got their own budget and they plan. That's all. What is the cost? And what is a cost object? So a cost is a resource sacrificed or foregone to achieve a specific objective. It's usually measured in monetary terms. So cost incurred could be past historical rather than budgeted. When you budget, you've not incurred it, so it's not a cost. So any cost we talk of is something which has occurred in the past and can be measured in monetary terms. What is a cost object? So a cost object, anything which has a separate measurement of cost. Okay, anything for which a separate measurement of cost is desired. It can be a product, a service, a project, an activity, a department. Examples like a bicycle is a cost object. A service like an airline flight from Manchester to Rome. A project like an airplane assembled by Airbus for British Airways. Activity like a test to determine the quality of a car. A department, the resources consumed by the marketing department is a cost object, and a brand category or soft drink sold by a brand. So that's a cost object, okay? Somebody will simply say a cost object is an object we can assign a cost to. It makes sense in a layman's language. So can I assign a cost to this phone, this water bottle? Can I assign it? Okay. So it's a product. Can I assign a cost to the haircut I undertook in the salon? Yeah. Okay. So any item for which you can assign a cost, you can attribute a cost. It's a cost object. Now, costs are being classified on the basis of the assignment to a cost object. So it can be direct cost or indirect cost. What is a direct cost? A direct cost is any cost you can directly link or trace to the object. That's it. Indirect cost, you cannot trace it to the object. So if you take a bicycle, the direct cost will be the rubber, the tube that goes into the tire, or the steel that goes into the frame. Direct, you can trace it. The indirect cost to a bicycle is the electricity which was used in welding. Can you trace electricity to the bicycle instantly? No. What about the water which was used? What about the supervision cost? You can't see it. Okay. Costs can also be classified on their behavioral pattern to changes in the level of a cost driver or cost driver. What drives the cost? Okay. So you can get a variable cost and a fixed cost. Variable cost is that when the units change, the cost will change. So they are costs which change in line with the production. Fixed costs do not change. So for example, if I buy a raw material, I need 10 tons of this raw material to produce product X, or to produce 10,000 units of product X. 10 tons for 10,000 units. So if I'm going to produce 20,000 units of product X, I will not need 10 tons. I will need maybe 20 tons. You get it? Fixed costs do not change. They remain fixed, like rent. You pay the rent for the factory for the whole year, regardless of whether activity goes on or not. It's still fixed. Cost can also be classified based on average or aggregation. So like the total cost or the unit cost. Okay. So total variable cost or variable cost per unit. You get it? Right. Then it can also be classified based on assets or expenses, financial statement perspective. So you could get product cost or period cost. When we talk of product cost, those costs can be traced to the product. They are linked. They are attributable to the product. Period cost, they are attributable to the period, the month, the day, the year. You got it? Good. And usually most product costs are direct and most period costs are indirect. Then we can also classify costs based on the business functions, the research and development, the design of the product, the services and processes of the organization, the production and marketing, distribution, customer services, manufacturing and non-manufacturing costs. So these are ways we can classify costs. Okay. So I explained this, but we can go through quickly again. Variable costs, they change in line with production, total production, or in line with the activity of volume being produced. Fixed costs, they do not change despite the level of activity. They remain the same no matter what. Variable costs per unit will normally remain the same when production units change. But fixed cost per unit actually tends to drop when production units increase because it's fixed. So if it is fixed and you are increasing production, divide the total production or the fixed cost by the fixed cost per unit, the fixed cost per the total production. So the more you produce, the fixed cost per unit declines. But the more you produce, the variable cost per unit remains the same. Then the reverse is true. Total variable cost, the more you produce, the total variable cost increases. But the more you produce, the fixed cost, total fixed cost remains the same. It doesn't change. Interesting, right? So costs are defined as variable or fixed and with respect to a specific cost object for a given period of time. So these are fixed costs, the straight line. Rent, it doesn't change. Insurance doesn't change. Salary paid to a supervisor. Depreciation of a machine using straight line, it doesn't change. So it is fixed, straight line. Right? So you find is that when units of production move from 500 to 400 to 500, it was still 10,000. To 800, it was still 10,000. To 1,000, it's still 10,000. It doesn't change. It is fixed in total. But if you like, try to do this calculation and see. So that 10,000 divided by 400, what do you get? 10,000 divided by 500, it will drop compared to what you computed for the 400. 10,000 divided by 800, it will drop. 10,000 divided by 1,000, it will drop. So the higher we produce, the more we produce, the fixed cost per unit, that's what drops. Fixed cost, like I said, it will drop per unit. If you divide it, you see that it keeps dropping and dropping and dropping. Right. Okay. Now we also have what we call step cost. It is a fixed cost. It remains fixed up until a certain level of activity. But when activity increases, it changes. Then it will remain fixed till a certain level of activity. Activity increases, then it changes. So it is step. Okay. So a cost fixed over a certain range of production or quantity, but then increases as the capacity or the usage increases. So that is step cost. Then we go variable cost. This will change in proportion to the changes in the value or level of production. So the more you produce, the more it goes up. If you don't produce anything, it is still zero. If you produce 200, it will increase to 10,000. 400, it goes to 20,000. 600, 30,000. 800, 40,000, so on and so forth. Examples are materials, labor, commission paid to a salesperson. The more you sell, the more you get some money. But it remains fixed, like I said. So they are constant as production level changes. Okay, as production level changes. Because it is directly proportional to the production units. All right. Then we've got what we call semi-variable cost, like the name sounds. It has both a fixed component and a variable component. So partially fixed and partially varies with the level of activity. Now, example like telephone cost. Telephone cost will normally have a fixed charge, and when you exceed that charge, you get extra charges. Same with even sometimes our electricity bills. You get a standing charge, and then it also progresses. All right. I will pause here. All right, welcome back. I had to adjust my settings a little. Right. So semi-variable cost, like I said, has a partially is fixed and then partially is variable. So it changes. Okay. Like our electricity bill, sometimes you get an electricity bill having a standing charge, which is fixed. So if you like, lock your door, travel for 2 months, you still come and get an electricity bill because there's a fixed component on it. All right. Let's move on. So we move into this concept of cost volume profit analysis. It typically examines the behaviors of total revenue, total cost. Total cost is made up of the variable and then the fixed, okay? And then operating profit as changes occur in the output level, the selling price, the variable cost, or the fixed cost. Question is, how many units do we need to produce and sell to cover the cost? Which cost? Fixed cost, operating cost. So it helps us to be very sensitive, perform a sensitivity analysis. How a result will change if the original data changes. How will revenues and costs be affected if we sell 1,000 more units? How will a change in the selling price affect the output level? If we expand into another market, will that impact on our cost? So you do a lot of sensitivity analysis, scenario analysis, simulation analysis. That is purely management decision making. Okay. Now, typically with a cost volume profit analysis, there is what we call the break-even point. At this point, you make zero profit, you make zero loss. It is the point where the total cost is equal to the total revenue. Look at this graph. I'll try to spend a little time here. So we know how variable cost behaves and how fixed cost behaves. So we can say the fixed cost, say we use a 10,000, okay? The variable is zero, and once it rises, it rises. So the total cost will start from the 10,000 here. It's a combination of the fixed plus the variable. So when we produce 200, variable cost will change. So variable cost will be some amount plus the 10,000. So that is the total cost moving here on that line. Once we sell, revenue also rises. So the revenue line is the one which starts from the zero. Normally, you would have used the variable cost line there. But of course, variable is also starting from the zero, but it will normally lie below the revenue line. So it is also the same thing rising up. Okay, rising up from the zero, but below this TR, total revenue line. Total revenue is simply the selling price times the quantity we sell. Okay, and the total cost is made up of the fixed cost plus the variable cost. Okay, that's it. How do we get the variable cost? It's the variable cost per unit times the quantity. It's simple. So what we see total cost is simply the total fixed cost plus the total variable cost. And total variable cost is the variable cost per unit times the quantity we produced. Okay. So at a point in time, you realize that the revenue line is below the total cost line here. That is why we rank it as the loss region. Loss, because the total cost exceeds the total revenue. But at this point, this particular point, I think 20,000 costs and some Q star here. At this point, you see that the total cost and the total revenue becomes the same. They become the same. That is a break-even point. Zero profit, zero loss. And thereafter, you see that the total revenue line rises above the total cost line. This is the profit zone. You would always want to be here. You would always want to be in the profit zone, right? To be safe, okay? So there are some key formulas. You hear contribution per unit. Contribution per unit is simply selling price per unit minus variable cost per unit. That's all. That's all. And so whatever you get, we are saying that divide your fixed cost. The fixed cost is like the operating cost. So divide your fixed cost by the contribution per unit and you get break even. What we are saying is that when you calculate the contribution per unit, it is more like the gross profit per unit. How many units should we sell at this particular level so that it can take care of all the fixed costs? That's all. So if I get a contribution per unit to be 5, and I know my fixed cost, total fixed cost is 10,000. So 5 times what units? Do you get it? Would help me get 10,000 break even. So any units beyond that becomes profitable. So we call it the margin of safety. So the margin of safety in units is simply the sales units in excess of the break-even point in units. That's all. So the units we sell to get a certain profit. Okay. Now again, you hear target profit. So target profit is saying that you make zero profit, zero loss, break even. Add that target profit to it. That's all. So it is the break-even point plus the target profit. So I want to make a target profit of 50,000. It is simply fixed cost divided by my contribution per unit plus my 50,000. That's all. Because my fixed cost divided by my contribution per unit will give me zero profit. So if I want 50,000, I only add 50,000 to the zero and I get 50,000, isn't it? So it's always easy to get some of these things. So what you see here, unit sale to get a certain profit or the target profit is your fixed cost, total fixed cost, okay, divided by what? Contribution per unit. It will give you zero profit, zero loss. Add that target profit to it. That's it. Okay, that's it. Very easy to work these things out. How do we get contribution? I've given it here as selling price per unit minus variable cost per unit. When you hear contribution margin, then you actually multiply the contribution by the total units you produce or sold. That's all. So you hear total contribution or contribution margin. It is not the per unit. That is a bigger one. You multiply by the number of units. All right. Let's take a typical example here. So selling price per unit is 50. Variable cost per unit is 20. How do we get contribution? It's the selling price per unit minus the variable cost per unit. 50 minus 20 gives us 30. That's a contribution per unit. Okay. If fixed costs are 3,000, the question is that how many units can I sell so that I can take care of these 3,000? That's why we use the word contribution. So contribution is saying that how many units, or let me just put it another way, how does this 30 contribute to my operating expenses? That's why they use the word contribution. So the 30 we got here is contributing to your expenses. Okay. So the question is, how many units can I sell at 30 to take care of 3,000? It's just 100 units, right? So 100 units, when I sell 100 units and I multiply it at this profit, will be 3,000. And it will take care of my fixed cost, and I get zero profit, zero loss, break even. Break even. So that's why our break even is given as a fixed cost, the 3,000 divided by a contribution per unit. That's it, gives you 100. So at 100 units, when you sell at 100 units, zero profit, zero loss. That's it. If you like, do this simple analysis. Multiply 100 by the selling price per unit, you get 5,000. Multiply 100 by the 20, you get what? 2,000. Subtract 2,000 from the 5,000, you get 3,000. That's a contribution margin or total contribution. So that 3,000 minus the fixed cost, 3,000, you get zero. You get zero. Right. So that's it. Now, any sales you make in excess of this 100 gives you good profit, margin of safety. Margin of safety. So when they ask you to find a break-even point in units, you get the units. That's it. We've calculated it. But if they ask you to find a break-even point in sales, whatever units you get, multiply by the selling price per unit. That's what I did. I told you, multiply this 100 units by the 50, get a 5,000. Okay. So that's it. The company needs to sell 100 units to contribute towards its fixed cost so that we'll get zero profit, zero loss. Right. Perfect. Again, consider the break-even point is 100. Like I said, that's what we calculated. And we sold 120. Oh, we'll make excess. Excess of 20, isn't it? That's all. That is our margin of safety. So you can get your margin of safety in units or our margin of safety in percentage. So our margin of safety in units is simply the 120 sales minus a break-even point of 100. We get 20. What about our margin of safety in percentages? If you know your percentage change, it's easy, right? So the 120 we sold minus the 100, which is the 20 expressing the 20 as a percentage of the units sold. That's all, giving it 16.7% as margin of safety. The name margin of safety says that in that margin, we are safe enough to make profits. Do you get it? There. So that's the terminology. Like in IT, in computer, they will say this is mouse, this is a monitor, this is a joystick. They've got their terms. In management accounting, they have also got their terms. Same like accounting also has its terms. If the company wants to make 600 profit, it's simply adding the 600 to their break-even. Okay, so you know the break-even. Break-even, go back, was fixed cost here divided by contribution per unit. So the 3,000 fixed cost over this 30, and then you add your target profit. How much target profit are we making? 600. You add the 600. That's all. That's why it's 3,000 divided by this plus 600. It tells you that we need to sell 120 units to make a target profit of 600. Easy, very easy. When you see this in any situation, we are wrapping up. Now, the role of cost information in pricing decisions. How do these costs help us in making decisions? We want to take 5, okay, the 5 pricing strategies. We've got a market scheming, loss leader, price discrimination, complementary products, and penetration pricing. So when we talk of a market scheming, we set a high price for a new high-end product, some new iPhone, some new gadget, okay? what happens is that we will achieve maximum revenue before people start imitating what we are doing. So we would have covered enough market. Now, subsequently, when we see that people have penetrated the market, we lower the price so that we can attract low-end buyers and to compete with these guys who have brought in copycat items. Market scheming. Nobody knows, hit the market hard, grab your revenue. When you see them coming, reduce your price to grab them. That's one pricing strategy. Then we got pricing, penetration pricing. So what happens is that you are going into the market, people have set their prices. What you want to do is you lower the price, low balling. Lower the price so that you can gain some market share and they accept it. So once they accept your product, you have achieved a high volume, you now decide that let's increase it. That's all. So look at the market. People are in, they are selling at £10, £10. You go in and you sell it at £8 or £7. You gain the market share, you sell enough volume, low price, could be sustainable. Then once the market share is achieved, increase your price. Here, you could introduce volume discounts, bulk discounts to make your way through. Then we got what complementary product pricing. So you go in and buy like a printer from HP. They give it to you at a very low price with the ink, with the toner. That's what they will do. They'll give it to you. So you find this, wow, 3-in-1 printer selling for $150. And then you buy it and you bring it. The toner will get finished. Once the toner gets finished, you cannot get any other toner unless you go and buy it from HP. And you buy it at a higher price. That's what they do. That's what we call complementary product pricing. The equipment itself comes with an accessory. But once you use it to a certain point, the accessory gets finished. And you have to go and buy it. Okay. So major product is priced relatively low. It will encourage you to buy and it will lock you in subsequent purchases of its consumables. Major product is priced relatively high. Sometimes it is priced relatively high to create barriers to entry. People cannot get into it or exit, and the customer is locked into subsequent purchases. Sometimes it's very high. The treadmills, you buy it and you can't even sell it. You have to just maintain it. Then we've got price discrimination. Like the name sounds, it is a strategy. The company will sell the same product or service at different prices in different markets. They look at you, you go and buy a cup of tea in a particular restaurant, and they know this guy is not an ordinary person, he's a high-end person, and they sell it to you at a higher price. You go and pick the train, you see that some people will sit in the business couch, others will sit in the normal place, or even like an airline. Like an airline, we've got a business class, the economy. But we all go to the same destination, but we will not all be treated the same because we don't pay the same. So here, seller will have some degree of monopoly power, and customers can be segregated into different markets. That's the price discrimination. Now we've got a loss leader strategy. Here, the company will set price below the market price. Their prices for their products are below the market price. Why? They want to bring customers into the store, assuming customers will be stimulated to buy full price items as well. So it's a potential for long-term benefit through customer equity. 30 bottles for 10. Come in. Just come in. And once you come in, they've advertised this particular item, but you end up buying something else, which is not advertised. So that's what they do. It happens a lot. You will even see some of these shops, they will say clearance, up to 50% clearance. So yeah, you enter, you think you're going to buy a shoe at 50% clearance, and you end up buying a dress to match it, but the dress was not advertised. All right, we end here. Good information there. Please try as much as you can to get used to this concept. Practice some questions on cost volume profit analysis and see how best you grab the learning points. It's easy, very easy, relatively easy. We've not gone into a detailed segment like the relevant range, no, because it's a bit basic. Okay. That's it. I'll see you on the other side when I see you. Take care. Bye for now.